Hey everyone, welcome back to Corporate Decoder. Today we're diving into Guru App Factory Corp's latest filing. It seems like they've had some pretty interesting shifts behind the scenes and the numbers are definitely telling a story. Make sure you subscribe and join our Discord community linked in the description below because we break down these kinds of reports so you don't have to. Alright, so this is a quarterly report, a 10Q for Guru App Factory Corp. They're reporting for the period ending April 30th, 2025. Think of this as a quick checkup on how the company is doing financially over the last 3 months. And also looking back further at the 9 months of the year. Guru App Factory Corp is a company that develops mobile apps and provides software development services. They're based in Nevada, but their principal executive offices are actually in London, UK. Interesting mix there. Let's jump straight into the numbers. Looking at their balance sheet as of April 30, 2025, they had total assets of $12,824. Now that's a significant drop from July 31, 2024, when their total assets were $68,131 2024 to just 1,651. And Welcard, Appleate, Eagle 3 in July 2025, so they've managed to cut down their debt significantly. What's really important is the deficit. As of April 30, 2025, their accumulated deficit was $54,947. This basically means the company has spent more money than it has earned since it started. And even though they've reduced their liabilities, this growing deficit is a big red flag for their financial health. Now, let's look at how they've been performing in terms of making money and spending it. In the 3 months ending April 30, 2025, they reported zero revenue. That's right, no income at all for that period, compared to the same period in 2024 when they had $53,000 in revenue. This is a complete halt in income generation. Looking at the 9 months ending April 30, 2025, their revenue was $94,500. This is actually an increase from the 9 months ending April 30, 2024, which was $78,000. So while the current quarter shows no revenue, the broader 9-month picture shows some growth. However, even with zero revenue in the recent quarter, they still had operating expenses. For the 3 months ending April 30, 2025, operating expenses were $23,484. This is a big drop from the $69,225 in 2023 in 2024 to $25 in 2025 to $27,2024 to $25 in 2023 botch year in the same period last year. Spending more overall this year, even though the last quarter was very lean. Because of this situation, their net loss for the 3-month period ending April 30, 2025 was $23,484. This is worse than the $16,023 $4 is worse than the $16,024 to $31,015 in 2025. This clearly shows that despite some revenue growth over Nielsen 2025T, is still operating at a loss and it's getting larger. Let's see how this loss affects their equity. As of April 30, 2024, their total stockholders' equity was $45,934. Fast forward to April 30, 2025, and their total stockholders' equity dropped to $11.23. This is a huge decrease, almost wiping out 75% of their equity. This is driven by the accumulated losses. It's also worth noting how they manage their common stock. In the period leading up to April 30, 2024, they issued a fair number of shares and also did so in the period before that to raise capital. However, in the more recent period up to April 30, 2025, there were no new shares issued, likely because the company wasn't performing well enough to attract new investors at that time. Now about cash, which is the lifeblood of any company. For the 9 months ending April 30, 2025, the company used $22,351 in cash from its operating activities. This means that day-to-day business operations consumed cash. Last year for the same period, they used $20,360, so their revenue increased, which points to higher operating costs relative to income. In investing activities, they spent $0 in the recent 9-month period, a big change from the previous year where they spent $15,978, likely on computer software as shown in the previous sections. This lack of investment could mean they are holding back on development or new tools because of their financial situation. Financing activities shows $0 cash provided in the recent 9 months, compared to $62,598 in the prior year. That financing last year came from a small loan from a related party and issuing stock. The fact that they aren't raising money through financing anymore, combined with zero revenue in the latest quarter, really underlines their struggle to attract funds. And the result of all this, their cash and cash equivalents at the end of the period, April 30, 2025, stood at a mere $690. This is critically low, down from $23,043 at the beginning of the 9-month period. It's alarming how little cash they have left. Something major happened on April 22, 2025. There was a change in control. The majority shareholder sold their shares to a new buyer. This led to the old CEO and a director stepping down and the new owner taking over as president, CEO, and CFO. This kind of leadership change can signal a shift in strategy or at least an attempt to turn things around. This note hits hard. The company itself admits there's substantial doubt about its ability to continue as a going concern. They have $54,947 in losses since starting and don't have enough revenue. They need more money, mainly from management and shareholders or outside investors. This is a very serious warning. Without significant new funding, they may not be able to keep operating normally. They mentioned following GAAP rules and a new accounting standard about segment disclosures, which they don't think will affect them much because they operate in just one business area. They also explained cash equivalents, where they consider highly liquid things with short maturities as cash. They also have a standard note about using estimates and assumptions in financial reporting, but they basically say they haven't had to make many complex ones except for the going concern assumption, which, as we saw, is a big issue. They detail how they recognize revenue, mostly when they deliver services or products and get customer acceptance. This applies to consulting, application development agreements, and mobile app development. It's pretty standard stuff for a service-based tech company. They also talk about amortizing their computer software assets and how they review for impairment. This means they are expensing the cost of their software over time, and they check if the software's value has dropped. For the 9 months, they had $897 in amortization, which is a small number, suggesting their significant software investments are from the past or are being depreciated slowly. In note 4, they clarified that advances from related parties are temporary and often not formalized. Since they started, their sole officer and director loaned $1,330 to loan for incorporation costs, and that amount was still outstanding as of April 30, 2025. This is a very small amount, suggesting their initial setup costs were minimal, but it also shows reliance on internal funding. They have a massive 75 million shares of common stock authorized, but as of April 30, 2025, only 7,106,000 shares were issued and outstanding. This means there's a lot of potential for dilution if they issue more shares in the future to raise money. Here's a positive update. After the reporting period on April 30, 2025, the former CEO Denis Volkovs forgave the $1,303 in outstanding related party payable. This forgiveness will be treated as a capital contribution, which is good news as it essentially becomes equity without requiring new cash. Now let's look at management's perspective on their situation. They reiterate that they develop and sell mobile apps and offer software development consulting. They primarily generate revenue from app development for third parties, advertising, and in-app purchases. They serve small and medium-sized companies with services like software development consulting, data encryption, and blockchain operations. Management acknowledges the accumulated deficit and the need for additional capital through equity or debt sales. They're hoping to fund their long-term operations this way. They explicitly state zero revenue for the 3 months ending April 30, 2025, marking it as a significant decrease from the prior year. They mentioned that the reduction in operating expenses in the latest quarter was due to cost-cutting measures. This aligns with the very low cash balance and shows them trying to conserve whatever little they have. This section confirms the drastic drop in assets and liabilities. The key takeaway here is their extremely low cash balance of just $692. This is a critical concern and means they have very little flexibility to handle unexpected expenses or invest in growth. They plan to fund operations through existing funds and more security issuances. They admit they have no lines of credit and rely on private placements and debt instruments. The plan is to increase operating expenses for inventory, development, and marketing, financed by more securities and debt. They also warn that future issuances could dilute current shareholders and that financing might not always be available on good terms. This paints a picture of a company constantly on the edge, needing external money to survive and grow. They report no off-balance sheet arrangements, which is standard for a company this size. They repeat the critical point that their auditors express substantial doubt about their ability to continue as a going concern, reinforcing the serious financial challenges they face. As a smaller reporting company, they are exempt from providing detailed market risk disclosures. Here's something important. Management admits their disclosure controls and procedures are not effective in ensuring that material information is recorded, processed, and reported in a timely manner. This means there's a risk that important financial information might get overlooked or delayed. They also state that recent management changes did not materially affect their internal controls. They report no legal proceedings, no unregistered sales of equity securities in the last 9 months, and no defaults on senior securities. The exhibits include standard certifications from their CEO and CFO and various XBRL documents for electronic data filing, which is required for SEC filings. Finally, the report is signed by Bong Dennis, the President and CEO and CFO, confirming the accuracy of the report as of July 15, 2025. So looking at the big picture for Guru Factory Corp, this filing paints a challenging, albeit somewhat stabilizing picture. The leadership change in late April could be a turning point, but the financial results are stark. Zero revenue in the most recent quarter, a dwindling cash balance down to almost nothing, and a confirmed lack of effectiveness in their disclosure controls are serious red flags. While they've managed to cut down liabilities and showed some revenue growth over a 9-month period, the overwhelming accumulated deficit and the very real doubt about their ability to continue as a going concern dominate the narrative. It seems the new management will have a tough road ahead to secure funding and turn this company around. The reliance on future equity or debt issuances is a constant sword of Damocles, threatening to dilute existing shareholders or simply not materializing at all. What's your take on Guru App Factory Corp's situation? Do you think the new management can steer this ship away from the rocks, or are the financial numbers just too tough to overcome? Let us know your thoughts in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe for more in-depth corporate analysis. And don't forget to join our Discord community for further discussions and insights. Thanks for watching, and we'll see you in the next episode of Corporate Decoder.